Good afternoon, everybody, and welcome to this edition of our weekly Broker Moves Review for Friday, 26th of March. My name is Carl Capilingua, and I'm the market analyst over here at Think Markets, and it is a pleasure to be with you as we delve into everything broker-related for the last week. We'll talk about the Think Markets difference before we do. $8 flat rate trades, your own holder identification number, unlimited phone support, and of course no hidden platform or subscription fees. 4 fantastic reasons to make sure your next ASX share trade is with Think Markets. The agenda for today is to check out all the key broker moves for the last week. So that's upgrades, downgrades, price target changes, and more. And then we'll have a look at a few stocks of interest a little later on. Ratings upgrades first up. And don't forget, each broker has a rating system for each of the stocks that they cover, basically telling their clients what to do. So along the lines of buy, hold, sell, and sometimes there's some quirky ones in between like add or accumulate. They also have a price target based upon their valuation for the company, where they think the price could get to over the next sort of 12 to 18 months. On screen, we can see the upgrades. For example, Macquarie Bank has upgraded AGL Energy from underperform to neutral, and at the same time, they've decreased their price target by 9.3% from 10.85 to 9.84, and that leaves about 5% downside to where the current share price is. So the current share price is higher than the target, and therefore, based upon that, the share price could fall back to the target by about 5%. Looking down the list, Macquarie was busy there on the banks. We've got Bendigo and Adelaide Bank getting upgraded from neutral to underperform, and Commonwealth Bank from underperform to neutral. Modest price target increases there, about 7.3% for Bendigo, just a couple of percent for Commonwealth Bank. A little bit of upside seen at Bendigo, not so much at Commonwealth Bank. Credit Suisse active this week as well. CSL going from neutral to outperform. Small decrease in the price target, but plenty of upside seen there from Credit Suisse on the stock, about 18%. Graincorp, they had an investor update during the week, and brokers quite positive towards that one. We can see Credit Suisse going from neutral to outperform. Decent price target increase there, about 11%, about 10% seen in terms of upside. Polynovo, Macquarie still likes the stock. Moved the rating to outperform. A nice price target increase by about 16%, about 10% to the good left in that one. REA, incidentally, Macquarie mentioned that they had done a survey of real estate agents, asking them whether they preferred the REA or Domain platform, and REA came out on top. So we've seen an upgrade here on REA from neutral to outperform. Price target goes up by nearly 9%, about 24% still seen in that one from Macquarie. And I'm going to skip to the next page first because it's worth mentioning here. Domain Group going the other way. So they've gone from outperform to neutral, and the price target dropping a massive 25.5%. Basically to where the share price is now. So Domain Group, the loser out of that trade. Macquarie on WiseTech, they said that they think the worst is behind the company. Actually, they upgraded from neutral to outperform. Nice price target increase there, about 18%, about that much seen left in it. And zero. Credit Suisse said that the recent pullback in the share price is creating a value-based buying opportunity. They liked the acquisition the company announced during the week. So we've seen a move to outperform from neutral from them. 14.3% increase in the price target, about 8% left to the upside. We've already talked about Domain Group. Interesting story here on Resolute. So they've got some mining interests in Ghana and Africa, and the Ghanaian government terminated their lease without notice on one of their gold mines. Incidentally, they're looking to sell that gold mine to another party, and therefore the deal is probably scuttled. The share prices tanked on that terrible, terrible news for them. It wasn't going so well because the gold price has been going down anyway, but you can see brokers reacting to that news. We've got Citigroup going from buy down to neutral, 17% drop in the price target. It looks like there's a lot of upside there, but that's because the share price has fallen so much. And Macquarie going from outperform all the way down to underperform in one hit, 45% decrease in the price target, 17% upside left from them. Sigma actually had some good news out during the week, so interesting to see Citigroup going from buy to neutral. So they had reported their results, which were better than the market expected, but clearly not better than what Citigroup expected. A small decrease in the price target from them. JP Morgan, their European research house, downgraded Unibail Rodamco Westfield, and therefore we've reflected the downgrade here. So hold to sell on that one. Decent price target decreased 17.8%, and plenty of downside seen. JP Morgan saying the stock is fully valued, and there's plenty of clouds, with respect to earnings, and clearly They don't like that one. Macquarie on Westpac. We saw earlier on they moved on Bendigo and CBA, but this time Westpac going the other direction, outperformed to neutral, but pretty flat there on the price target and what's left in it. Banks have had a good run. I think they're just responding to that run. Have a look at the price target increases. So ratings staying the same here, but the price target changing. I'll let you press pause and see if your stock's in there. We'll just try and pick out the more interesting ones. CPU came out during the week. They said they're going to acquire Wells Fargo's corporate trust operation in the US. Brokers largely like the deal. It's going to be earnings accretive fairly quickly according to the business. And we've seen accordingly some nice price target increases there from Citigroup, JP Morgan, Macquarie, and Morgan Stanley. Really nice one there from Macquarie. They still see 40% in it. They've got an outperform on the stock, and it looks like Morgan Stanley's got an overweight, but not everybody agrees clearly because we've still got an underweight from JP Morgan and a sell from Citigroup. That's a stock of interest. We'll talk about that a little bit later on in more detail. Crown Resorts, also a stock of interest. They had a takeover bid lobbed at them from private equity group Blackstone, who actually is on the register. They own 10% of the business. A little bit of a conspiracy theory. We'll talk about that a little bit later on. Graincorp, they had an investor briefing, market update. Brokers liked what the company had to say, and we can see, therefore, prices going up 10%. At Credit Suisse, nearly 4% at Macquarie, but a big move there at UBS. UBS the most bullish. They're a buy with 29.4% lift in it. But, hey, Credit Suisse and Macquarie both outperform. Probably a stock you want to take a closer look at. Moving down the list, looks like crazy moves there from Cenex Energy. It's not a typo, it's more of a quirk. We talked about last week, they had an 8-for-1 consolidation. So effectively you've got 8 times fewer shares, if that's how you say it. But to compensate for that, the share price goes up by 8 times, and brokers literally just multiplying 44, 47 and 42 by 8 and getting those numbers. So it's nothing to get too excited about, but brokers still fairly positive on it. We've got a buy there from Citigroup and JP Morgan. Looking down the list, so we've talked about the last couple, and Xero, we've talked about that one as well. Let's get into the price target decreases there, looking for big ones around. Bubs, that's an interesting one. So Citigroup just updated their view on that one. The company's been struggling anyway because it's got an infant formula business, massive exposure to China. We know that COVID has impacted the ability for movement between the two countries, and there was a nice side hustle there from a lot of Chinese students who came over here, bought baby formula and sent it home to be sold over there. They can't do that now, obviously, because of border restrictions, and that's had a big impact on the company's earnings. And Citigroup there, look, 31% decrease in the price target. They still think there's 30% downside in the stock. That's quite shocking, and they're a sell on the stock. You don't need to read between the lines to see what Citigroup thinks of it. And there's a few here which look pretty nasty. We've talked about Domain, but I note that, with the exception of Resolute, there's still plenty of upside seen in the respective companies, and the brokers are all still pretty positive, so I don't think we need to get too concerned about those. Going to the last page, we talked about those two already. Takes us to our stocks of interest. First one is Brickworks, and we might kick off with UBS's comments because they're quite interesting. They say, obviously they retained their buyer rating, increased the price target from 22.70 to 23.64, but they said that this half-yearly result that the company announced is showing that the company is a bit more of a property division rather than a building products division, which is what we would normally associate with a company with a name like Brickworks. As the name suggests, they make bricks for the building industry. But a massive result from their property division. They also have a bunch of they have a property portfolio, but a lot of the exposure there is to those warehousing and distribution style assets. And of course, they've gone crazy good during the pandemic because we're all buying things online. So you need places to store these products before you send them out. So very interesting way of looking at it from UBS. They say that investors require a rethink on how they should view the business. The building products earnings were actually below expectations as far as UBS are concerned, but should improve, I guess, as local building focused stimulus programs kick in and US weather improves, because we did have that big whiteout in some of those southern states. Citigroup also increased their price target from 22.70 to 23. They retained their buy rating. They did again note that the FY21 results were mainly juiced by the property division. The earnings outlook, more broadly speaking, though, including the building products division, is improving. We mentioned stimulus packages before, and that should drive growth. Macquarie, a bit more circumspect about the company and the result. They actually decreased their price target from 2060 to 2030, retained their neutral rating. The results were fantastic, so no problem with the results. Mainly, it's just about the fact that the stock, in their opinion, is fully valued. Having a look at what the broader broker environment is for this one, it's generally at a buy. We've got 2 strong buys, 3 buys, 1 hold, no sells, no strong sells. The average price target for the company is 21.76, which is kind of up here, so there's a bit of upside in it. And this target will rise as some of these increases get filtered into the system, because there's a little bit of a delay for this data provider. But that's pretty positive going forward. In terms of the fundamentals, what can we find here? The PE is not inspiring. You wouldn't say it's the cheapest stock in the world. And that PEG, I wonder if that's a typo. It looks astronomically high, and I'm surprised by that. But there are some crazy numbers going around due to the impact of the pandemic. But the dividend yield looks very solid here. Price to free cash flow looks very, very solid indeed. I should say enterprise value to revenue isn't exciting me. Return on equity is a little bit average. Look, I would give that probably a C at this stage, maybe if I'm generous, a C+. So whilst we probably can't give it a tick there, we can certainly give it a tick there. The chart looks good. I mean, we've got this long-term uptrend in place. The price is clearly being supported by that long-term uptrend. We've just had a nice little pullback to it. Hey, you're probably better off buying pullbacks into that long-term zone, or even if we get a nice pullback here to 1950, where there should be some support. But overall, fantastic basing pattern and a very good possibility that we actually break through here and go up and hit those targets. So look, 2 out of 3 ticks from me. You make up your own mind. Have a look at Computershare. As we mentioned earlier, they did have that acquisition, widely well received by brokers. We've got, I think they were all price target increases here. And when it comes to Macquarie, a very, very big one indeed. From 16.45 all the way up to 21, they are the most bullish of the brokers. Outperform, what else have we got here? We did say they were a bit mixed, aren't we? We've got outperform and overweight from Morgan Stanley and Macquarie, but sell and underweight from JP Morgan and Citigroup. I'll let you press pause and read the comments. As I said, generally well received that acquisition. The earnings will flow through from this probably in the medium term. The company's maybe a bit more bullish than some of the brokers, but it's a good strategic acquisition, makes a lot of sense. The brokers are a bit neutral on this one, let's face it. Average of a hold there, 5 buys, that's impressive. But when you do have strong sells in there, it does make you wonder why sometimes. But sometimes this data's a little bit old, and those brokers will catch that up. The mean target is 15.60, but should go up. Definitely will go up based upon these increases. It does provide some upside in the share price. Looking at the fundamental numbers here, not impressed by the enterprise value to revenue. PE doesn't look cheap. It's not all that expensive, but it's certainly not cheap. And again, we've got some funny numbers here on the PEG. Dividend yield's fairly reasonable. Return on equity is excellent. I'd give this a better grade, I think, than Brickworks. I'm going to give it a B, a solid B. This is a question mark. I'm going to give that one a little tick. The chart's actually pretty good, I think. We've got a long-term uptrend. Just clicking in here, we've got a pretty good base pattern through here. I think if it breaks through 15.50, then it can go higher and target probably 18.39. Plenty of support in and around that 14.50 level. Have a look finally at Crown Resorts. We mentioned that takeover bid earlier. I mentioned also a potential conspiracy theory here. So JP Morgan said that the bid from Blackstone at $11.85 a share is inadequate, firstly, but given Blackstone is already a major shareholder with 10%, the move could be aimed at flushing out a higher competing bid from Star Entertainment Group. You never know, it makes sense. They increased their price target from $9.50 to $11. Credit Suisse went from $12 to $13.50, retained their outperform rating. They said that the $11.85 per share bid is opportunistic and doesn't take into account the likely earnings swing post-pandemic. So that's a definition of opportunistic, I guess. On a side note, they see a very low risk of the company losing any of their licenses, and that's obviously another big factor for the company's valuation going forward. In terms of what the rest of the brokers say, brokers are very neutral at this point in time because I guess there's a lot of uncertainty around the stock. The mean target is 11.79, which is very interesting. Out of the 3 stocks we've looked at in detail today, that's the only one with a target actually below the current share price. I guess, look, that will catch up to this takeover bid and brokers coming in with higher targets. Looking at the fundamentals, we don't have a lot to go on here because COVID has driven a major truck through those earnings results. So we don't have a PE because we don't have profits for the current financial year, and dividends are probably suspended, but double check that, correct me if I'm wrong, and return on equity has crashed. So yes, no, unfortunately for Crown, it's an F for FY21. Looking at FY22, it's going to get better, but at best it might be a C. The chart looks pretty good though. I mean, there's this great base pattern through here. The pop-up, look, it's takeover impacted. It's hard to say where it's going to go from here. If the bid gets pulled, it'll come back down and test the 11 level, but there is the chance that a higher competing offer comes out, in which case it'll pop up. So I'm going to pass, I think, on this one in terms of whether I would buy, hold, or sell. And I think really that's telling you that if you've got it, probably hang in there. If you don't, then stay away. Okay, that's it for me today. If you'd like to catch any of our other news updates, head to the market news section of the website. We have plenty of news, views, and opinions for you. You can follow me or the Think Market handle if you like there on Twitter. In terms of upcoming events, these are all webinars, so you need to go to the webinars section of the website to register for Ask the Experts coming up next Wednesday, where you bring your portfolio to the table. You get to control the conversation. I'll talk about the stocks that you would like to investigate. Then we have our top ASX turnaround plays. Crown could probably fall into that category. That's on the 21st of April. You can see there's a little bit of a break between this one and this one because I will be taking some leave. And then we're back with Us the Experts on the 28th and a fundamental analysis refresher. So all of those fandangled fundamental analysis ratios I just talked about, we'll go through how to find the data to calculate those and then how to interpret them as well. The disclaimer before I leave you today says that everything we've discussed is general in nature. We are a regulated Australian broker. We do have some products that could see you lose more than your deposits. So please read this disclaimer carefully or give us a call if you have any questions at all. It's been a pleasure chatting with you today. All the best for your trading until we catch up again. Bye-bye for now.